Payday loans are marketed as short-term financial lifelines, but research indicates they frequently function as long-term debt traps. With average APRs often exceeding 391%, these loans are statistically designed to be unaffordable. This report outlines the mechanics of the debt trap, the impact on vulnerable demographics, and the associated health and economic consequences. A payday loan is a small dollar, short-term unsecured loan, typically ranging from $100 to $500, due in full on the borrower's next payday. To secure the loan, the borrower provides a post-dated check or electronic access to their bank account. While the industry argues these loans provide access to credit, the business model relies heavily on repeat borrowing. Data suggests that the majority of industry revenue is generated from borrowers who are unable to repay the loan, forcing them to renew it. Payday lenders charge a flat fee rather than a recurring interest rate. A typical fee is $15 to $30 per $100 borrowed, and the annualized cost is staggering. A $15 fee on a $100 loan with a 14-day term amounts to a 391% APR. High-interest credit cards typically cap at 25–30% APR, and personal loans often range from 10–35%. In states without strict usury caps, APRs can legally surpass 600%. The core danger of payday loans is the churn, or rollover cycle. Borrowers often lack the liquidity to pay it off while covering rent, food, and utilities. Approximately 80% of payday loans are rolled over, or followed by another loan within 14 days. The average payday borrower remains in debt for 5 months out of the year, paying more in fees than the original loan amount. Nearly 20% of borrowers eventually default, leaving them in a worse financial position. Payday lenders concentrate their storefronts in specific neighborhoods, impacting minority and low-income populations. African American and Hispanic borrowers are nearly 3 times more likely to use payday loans than white borrowers. Storefront density is significantly higher in minority neighborhoods, even when controlling for income. The target demographic usually earns less than $30,000 annually. These borrowers are asset poor, making them susceptible to predatory terms. The Military Lending Act, MLA, now caps interest at 36% for active duty service members. Lenders often make repeated attempts to withdraw funds, triggering overdraft fees. This can lead banks to close the borrower's account, pushing them out of the banking system. Payday loan usage acts as a catalyst for insolvency. Studies have linked access to payday loans with a nearly doubled rate of Chapter 13 bankruptcy filings. The stress of unmanageable debt has measurable physical and psychological effects. High-interest debt is correlated with higher rates of anxiety, depression, and high blood pressure. The financial strain often diverts funds from essential needs, creating spillover effects that harm the health and stability of the borrower's family. Consumers have several alternatives that avoid the dangers of predatory lending. The data supports the conclusion that payday loans pose a severe risk to consumer financial health. The structural design of the product systematically traps borrowers in a cycle of debt. For the majority of users, payday loans do not solve a financial emergency. They create a new, longer, lasting crisis. We encourage everyone to never use a payday loan whenever possible.